This chart maps the distribution of profits across prediction markets, revealing a massive structural imbalance. Out of millions of active accounts, 96% are essentially financing the platform. Just 3.14% of accounts consistently capture more than 30% of all market gains. The immediate assumption is that this winning minority possesses superior forecasting abilities, or perhaps a deeper understanding of fundamental geopolitics. Analyzing the on-chain data proves otherwise. These outsized returns do not stem from predictive accuracy. They are generated through latency-driven structural arbitrage and institutional delta-neutral market making. There is, however, a secondary driver of these profits, asymmetric information, and traders who rely on this edge make a critical error when they assume a blockchain's pseudonymous wallet structure provides them with legal cover. Trading prediction markets based purely on fundamental analysis is a statistical trap. Winning at scale requires either a dedicated algorithmic infrastructure or taking on massive federal liability. This is a time series chart mapping the pricing of mutually exclusive outcomes on a prediction market. When you combine the cost of yes and no shares, the total should exactly equal $1. But occasionally, pricing inefficiencies cause that combined cost to dip below the $1 threshold, allowing a trader to buy both sides and lock in a risk-free return. This is known as market rebalancing arbitrage. This inefficiency is not theoretical. By plotting the cumulative volume of these exact pricing drops, academic researchers analyzed the historical order book data and identified roughly $40 million extracted over a single 12-month period. Capturing that value is entirely constrained by infrastructure. Because blockchain gas and platform fees act as a fixed cost, the gross profit margin on the spread must exceed roughly 2% just to break even. A human trader interacting with a web interface is far too slow to execute this trade. Capturing these fleeting spreads requires bypassing the front end entirely and piping orders directly through specialized API clients. Even with an API, the final hurdle is managing gas priority within the blockchain mempool. Your algorithm has to dynamically adjust transaction fees to aggressively front-run competing bots aiming for the exact same mispriced fractions. Retail speculators log on expecting to monetize their informational edge, but the structural reality is that their liquidity is simply financing a high-frequency latency game dominated by algorithmic infrastructure. The volume on these platforms has scaled to the point that Tier 1 proprietary trading firms like Susquehanna and Jump Trading have established entirely dedicated event contract desks. Here is a schematic mapping their order flow routing. Instead of taking directional bets on specific outcomes, these firms post continuous two-sided quotes into exchange infrastructures, extracting profit strictly from the bid-ask spread. To an institutional desk, event contracts serve a completely different function than traditional options. While traditional options hedge price risk, how far an asset's value will move, event contracts isolate discrete outcome risk, hedging whether a specific event happens at all. Firms like Merrick's Group are already utilizing these platforms to construct and hedge custom-structured products. For instance, they recently issued a $10 million note that pays a guaranteed coupon solely if NVIDIA maintains its rank as the world's largest company by market cap. Institutional capital does not treat prediction markets as gambling venues. They view them strictly as environments for liquidity provision and highly precise factor hedging. On the other end of the market, accounts attempting to trade on asymmetric information are highly visible. Academic surveillance is already formalized, most notably through the Foresight Flow framework, which calculates an information leakage score. Looking at this step chart, we can see exactly how the framework operates. The x-axis tracks the time leading up to a public news event at T0. The information leakage score quantifies the exact fraction of the final price move that was already priced into the market before the news actually broke. When researchers audited verified cases of on-chain insider trading, a clear pattern emerged. Documented insiders do not trade on immediate, unpredictable news triggers. They systematically exploit contracts with fixed deadlines where the resolution timeline is known in advance. To isolate these anomalies, researchers fit an exponential hazard baseline to the time-to-event distributions. By applying a mathematical curve, specifically utilizing a 2.9-day half-life variable, they establish a baseline of normal market behavior. This methodology is actively deployed to analyze geopolitical event clusters. Any order book activity that aggressively deviates from the hazard baseline generates an immediate, real-time behavioral flag. Because every trade is permanently recorded on a public ledger, regulatory subpoenas are no longer required to uncover illicit trades. Academic detection models can flag insider trading mathematically the moment the order is filled. The legal framework governing these platforms is aggressive. The Department of Justice and the Commodity Futures Trading Commission prosecute insider trading on swap contracts under the misappropriation theory. Consider the recent indictment of Master Sergeant Gannon Ken Van Dyke. He had access to classified military intelligence regarding the timing of a sensitive tactical mission, Operation Absolute Resolve. Van Dyke placed $33,000 in wagers predicting the exact date that foreign leader Nicolas Maduro would be captured. Within days, those positions resolved, paying out over $400,000 in profit. This matches the profile of Michelle Spagnolo, a Google software engineer who extracted $1.2 million from the markets by trading on confidential metrics he previewed through an internal company tool. Both men attempted to obfuscate their payouts by routing the proceeds through decentralized swappers and cryptocurrency privacy services. Those evasion tactics triggered additional wire fraud and money laundering charges, which carry maximum sentences of 20 years in federal prison. Insider trading prosecutions in prediction markets do not require the information to relate to corporate stock. If you misappropriate confidential information in breach of a duty to your employer and use it to trade, you are committing a federal crime. The scope of this federal liability is expanding rapidly. Prediction markets now price private company valuations, allowing traders to bet on specific market cap milestones for entities like OpenAI and SpaceX. These contracts are resolved using exclusive data provided by Nasdaq Private Market that directly links the wagers to actual secondary market transactions. Standard institutional workflows, such as an analyst reviewing a funding round term sheet or an auditor verifying a capitalization table, now instantly create massive populations of professionals holding material non-public information. If an analyst uses internal fund data to take a position on an event contract before that valuation prints publicly, they meet the exact criteria for prosecution under the misappropriation theory. Until decentralized exchanges successfully implement zero-knowledge order books to blind trade timing and sizing from the public ledger, bringing professional knowledge into these markets is not alpha. It is a direct path to a wire fraud conviction.